What are the reporting requirements for foreign corporations? When a US company starts doing real business in Canada, it stops being just a foreign name on an invoice and starts looking like a taxpayer. That change brings reporting duties. Some of those obligations sit in Canada, tied to the income you earn and the tax you collect. Others sit back home, where your own country wants to know how you are using foreign entities and moving money across the border. None of it is optional once you reach basic thresholds. The trick is to separate three buckets in your mind: Canadian tax filings, Canadian corporate and regulatory filings, and home country reporting about your Canadian presence. Once those buckets are clear, the rest is mostly process and discipline. Canadian corporate income tax returns. If a foreign corporation carries on business in Canada or has a permanent establishment there, it generally has to file Canadian corporate income tax returns reporting its Canadian source business income. That can happen either because you run a Canadian branch directly from your US company or because you have a Canadian subsidiary that earns income in its own name. For a Canadian subsidiary, the rule is straightforward. The subsidiary is a Canadian resident corporation and files annual corporate returns on its worldwide income, with foreign tax credits where appropriate. For a branch, you are carving out the profits attributable to Canadian operations using treaty rules and transfer pricing principles. In both cases, the filings are not something you skip just because your head office is in another country. Sales tax and payroll reporting. If you register for GST or HST, you are on the hook for periodic sales tax returns, showing how much tax you collected and how much you are claiming as input tax credits on eligible expenses. Reporting frequency depends on your revenue and filing choices. Even if your net position is a refund most of the time, the return itself is still mandatory. Once you hire Canadian employees, payroll reporting appears. Employers withhold income tax and social contributions at source and remit them on a regular schedule. They also file year-end summaries and slips showing what was paid and withheld. Those are not just accounting niceties. Failing to remit on time is taken seriously, and directors can be on the hook personally in some situations. Information returns on cross-border transactions. Foreign corporations that do business with related parties often face extra information return requirements. Intercompany loans, service fees, royalties, management charges, and other related party payments can trigger separate disclosure forms and transfer pricing documentation expectations. The idea is simple. When a Canadian subsidiary or branch pays a foreign parent or affiliate, tax authorities want to see that the pricing is roughly what independent parties would agree to. Reporting obligations are how they get the visibility to test that. Ignoring those forms may not hurt you immediately, but it raises the stakes if the relationship is ever audited. Withholding and remittance reporting. Whenever a Canadian corporation pays certain types of income to a non-resident, such as dividends, some interest, or royalties, it generally has to withhold tax and file reports showing what was paid and what was withheld. That often includes slips to the recipient and summary forms to the tax authority. For a US group using a Canadian subsidiary, those reports are part of the routine when money flows back across the border. Reporting is how you prove that you applied treaty rates correctly and remitted the right amount at the right time. Corporate registry and beneficial ownership reporting. Separate from tax returns, corporations have to keep up with corporate registry filings. That usually means annual corporate returns confirming directors, registered office, and basic details for the jurisdiction of incorporation, plus any extra provincial registrations. Missing those filings does not usually trigger tax trouble, but it can push your status to not in good standing or, in the worst case, lead to administrative dissolution or cancellation of your authority to operate in that province. There is also a growing push for beneficial ownership transparency. Foreign-owned corporations may be required to maintain internal registers of who ultimately controls them and to share that information with governments or banks when asked. That is not a classic return, but it is a real reporting expectation. Home country reporting about foreign corporations. On the US side, owning or controlling a Canadian corporation can trigger its own reporting. US tax rules often require detailed disclosures about foreign subsidiaries, including balance sheets, income statements, intercompany payments, and information about shareholders. If you run a branch instead of a subsidiary, you report Canadian branch income directly in the US entity, and you may still need to track foreign tax credits and treaty positions carefully. From a management perspective, this means every cross-border structure comes with a second reporting shadow. You are not just filing in Canada, you are converting that information into whatever your home authorities want to see. Why systems and integration matter. What all of this really means is that reporting requirements are not just a legal checklist, they are a systems problem. If your Canadian operations sit on an island with their own accounting logic, it becomes painful to produce reconciled tax returns, information returns, and consolidated group reports. As soon as you know Canada will be more than a side project, it pays to design chart of account structures, documentation practices, and closing processes with cross-border reporting in mind. Final thoughts. Foreign corporations that touch Canada do not just file one extra form. They step into a reporting ecosystem that covers income tax, sales tax, payroll, intercompany payments, withholding, corporate registries, and home country disclosures about foreign operations. The sooner you map those obligations and build them into your regular closing cycle, the less they feel like a recurring emergency. If you want more plain language breakdowns like this, you can explore resources at www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.